Good morning and welcome to your daily solo 401k webinar Q&A session with my solo 401k financial. Here we try to help you save on taxes by utilizing a solo 401k plan, which is a tax shelter vehicle. And hopefully you can really get your retirement account supercharged. That's one of the benefits of a solo 401k plan when you compare it to an IRA, for example, in that you can contribute quite a bit to a solo 401k plan when compared to an IRA. So hopefully when we put on these daily webinars, it'll help you to stop overpaying taxes by making contributions to your solo 401k plan. So today's topic is you still have time for 2025. In other words, how to open a solo 401k plan here in 2026 for the first time and still make certain retroactive tax deduction contributions for tax year 2025. Looks like we've got some questions here. Again, we use these daily webinars for a variety of purposes. One, we cover new topics. Second, for you to ask questions, whether you're an existing client, prospective client, or just a solo 401k nerd that wants to learn about solo 401k plans. We put these webinars every day, typically at least once a day, many times twice a day. We'll be going live again today, for example, at 1 p.m. Pacific time for a second time. So go ahead and use the chat, type over your questions, make sure to type them over so they're in the queue, and then we'll answer those questions as they come in. They don't have to be specific to today's topic. They can even be regarding any topic about self-directed IRAs. So we are well versed on solo 401k plans as well as self-directed IRAs. So that being said, we'll take a look at it. It looks like we've got a couple questions in the queue already. So we'll take a look at those in a moment. But first, let's go over a few slides here on today's topic, which is still time for 2025. How to open a solo 401k plan in 2026 and retroactively claim tax deductions for tax year 2025. Of course, before you can even open a solo 401k plan, make sure you're eligible. So in order to open a solo 401k plan, you need to be self-employed. You need the business type can be any type of business, whether a sole proprietorship, LLC, S corporation, partnership, C corporation. You just need to make sure that you do not employ any W-2 employees in your business who is not an owner in the business. If you do hire someone who's a W-2 employee and they're not an owner in the business, then that person cannot work 1,000 hours or more in your business. So if you hire what's referred to as a common law W-2 employee, which is a way of saying a W-2 employee who is not an owner in the business and that individual works 1,000 hours or more in your business, then you would not qualify to open a solo 401k plan. So in short, it's not the entity type that determines whether or not you qualify for a solo 401k, but rather whether you're doing the work and also making sure you do not hire anyone who is not an owner that's a W-2 employee and works 1,000 hours or more. A caveat to that is that you can always exclude contractors in your business. So if your business hires contractors, it doesn't matter how many hours they work, they can always be excluded. Therefore, you would qualify for a solo 401k plan. And as long as you don't hire a W-2 employee that works 1,000 hours or more, then you would also qualify for a solo 401k plan. And lastly, you have to apply that 1,000 hour full-time employee eligibility requirement across all of your self-employed businesses. So if you own multiple self-employed businesses, and typically if you own 80% or more of any of those businesses, and any of those businesses employ a full-time W-2 employee who is not an owner, then you most likely will not qualify to open a solo 401k plan. That's known as the control group / affiliated service group regulations. And we have a page on our website that really delves deeper into those control group regulations. So let's take a look at some questions here, and then we'll jump back and continue discussing today's topic. Here's a question here. My solo 401k just hit 250,000 this week. Well, congratulations. Do I need to do a 55 easy now or next year? I went on your website and it looks like the sign up on there now was for the 2025 tax season. Great question. So the Form 5500 Easy, which applies to self-employed plans like a solo 401k plan, only applies if the market value of that solo 401k plan as of the end of the prior year was greater than $250,000. And you have to add up all your investments, all the funds in the plan, all your participant accounts. So if your plan holds pre-tax, Roth, and voluntary after-tax funds, or if both business owners are participating in the plan, for example, many of our clients are married and both spouses work in the same self-employed business. Therefore, the plan is sponsored by that self-employed business, and both spouses are eligible to participate in the same plan. So from a Form 5500 Easy side of things, you would need to add the value of all the participant holding accounts, so both spouses, if they both have funds in the plan, and all the investments. And when combined together, if the market value is greater than $250,000, then a Form 5500 Easy needs to be filed. Now, in your situation, it doesn't look like you need to file a Form 5500 Easy if the value of your solo 401k plan was less than $250,000 in market value as of December 31st of 2025. So if it just crossed that $250,000 threshold here in 2026, then you're going to want to monitor that. Because if the market value of that solo 401k plan is greater than $250,000 as of December 31st of 2026, so as of the end of this year, then you're going to need to file Form 5500 Easy by July 31st of next year. So July 31st of 2027. And we do have an online form that you would fill out. And we're going to be updating our website to list that form here in the near future that you would fill out so that you can communicate to us that we need to prepare a Form 5500 Easy for your plan, and we'll also file that form electronically with the IRS, so the government. So we'll get more into this, but here is my solo 401k financial. We don't charge additional fees for the preparation of Form 5500 Easy or Form 1099-R. As long as you timely request those returns, we'll go ahead and prepare them. So that's all covered in our annual fee of $125. And our annual fee, for those who are curious, that annual fee is very low. It's only $125. And the main purpose of that fee is to cover the fee for us being the solo 401k plan provider. So in order to open a solo 401k plan and continue with the solo 401k plan, you need to have a solo 401k plan provider like my solo 401k financial. So that's why our fees are so low, but we've taken it a step further. And we've also included in that annual fee, because of economies of scale, because we have thousands of clients, that we've included preparation of Form 1099-R, 5500 Easy. We'll also consult on the rules and regulations, whether contributions, distributions, conversions, you name it. We'll also shepherd you through understanding how to make contributions, perform contribution calculations, help you transfer IRAs, former employer plans to the solo 401k plan. In short, the only thing we don't handle here at my solo 401k financial is providing investment advice or holding your funds. We're not financial advisors. We're not depository taking institutions. That's why we're so popular, because a lot of advisors work with us to open up solo 401k plans for their clients. On the institutional side, we also have a large retail book of business. So we'll let the client choose where to hold the funds at, and we'll talk more about that in a little bit. Okay, good question. We'll take a look at some more questions here after we go over a couple more slides here. You have to pardon me, I've been fighting a bad cold here. So the key strategy overview regarding today's topic is that you can still open a solo 401k plan here in 2026 so that you can make contributions for tax year 2025. So the IRS regulations allow you to make prior year contributions to a solo 401k plan if the solo 401k plan is adopted by the business tax return due date plus timely filed extension. So why does this work? Well, again, the IRS regulations allow for it. But what is more, Secure Act 2.0 changed the rules regarding when a plan needs to be adopted so that you can make prior year contributions. So you can make certain types of contributions here in 2026 for tax year 2025 if you open a solo 401k plan for the first time here in 2026. Of course, on a side note, if you already opened your solo 401k plan by December 31st of last year, so 2025, then you've already met the establishment deadline, and therefore you automatically have until your business tax return due date plus timely filed extension here in 2026 to make tax year 2025 contributions. And that's true for all contribution types, whether employee contributions, employer profit sharing contributions, and or voluntary after-tax solo 401k contributions. But for those who are opening a solo 401k plan for the very first time here in 2026, and assuming they had earned income from self-employment in 2025, then it's good to know that you're going to be able to make some types of contributions here in 2026 for tax year 2025 if you open a solo 401k plan for the first time here in 2026. So employee contributions, you're going to be able to make those here in 2026 if you open the solo 401k plan under certain circumstances. And we'll talk about that here in a moment. As far as employer contributions, yes, whether you make those as pre-tax or employer Roth solo 401k contributions, those can be made in 2026. If you open the solo 401k plan here in 2026, those can be made for tax year 2025. So employer contributions for 2025 qualify to be made here in 2026, provided you open that solo 401k plan timely here in 2026. Same is true for voluntary after-tax solo 401k contributions. Those can also be made for tax year 2025 here in 2026 for those who open a solo 401k plan for the first time here in 2026. And that voluntary after-tax solo 401k contribution is part of the mega backdoor Roth strategy, which we're going to talk about further. Before we get into the various entity types, let's take a look at some more questions here. So here's a loaded question. It's such a loaded question that we've performed several webinars on this topic. How is a solo different from a SEP IRA? So if you subscribe to our YouTube channel, you can listen to over 1,100 webinars that we've put on regarding all topics about solo 401k plans. And there are several videos there that compare a solo 401k versus a SEP IRA. So please like today's video. Please subscribe to our YouTube channel. It helps get the word out to other solopreneurs like yourself and you will also receive notifications of when we go live. So please just take a moment to subscribe to our YouTube channel. And at a high level, the difference between a solo 401k and a SEP IRA are many, but here are a few um, items to consider. One, a solo 401k plan allows for the auto contribution credit, which is a $1,500 government stimulus credit for those who are self-employed that open a solo 401k plan. With the retirement crisis in this country, the government has decided to allow self-employed individuals who open a solo 401k plan to be able to claim a $1,500 dollar for dollar credit on their business tax return for opening a solo 401k plan. We're going to talk about that more. That credit is not available to SEP IRAs, so that's a $1,500 difference right there. Second, with the SEP IRA, you can never borrow from a SEP IRA like you can from a solo 401k through a solo 401k participant loan. And one last item, again, subscribe to our YouTube channel. You can access the webinars we've done on this topic. This is a topic that we've probably have overkilled, but have overdone. So as far as another difference is that a SEP IRA does not allow for the mega backdoor Roth strategy. That's another huge difference, whereas the solo 401k does. So those are just some of the differences. And lastly, it's worth noting that you can transfer a SEP IRA to the solo 401k plan. And if you open a solo 401k plan with my solo 401k financial, we'll make sure to help you pick up that SEP IRA and move it to the solo 401k so it doesn't trigger a taxable event. It'll be processed as a non-taxable direct rollover. So it's not going to be taxable. See if we have some more questions. Here's a question. I deposited money into my solo 401k pre-tax prototype account at Fidelity in December. Fidelity did the transfer in 2026 to my Roth IRA. Will this money count against my 2025 or 2026 limit? So let's see, I deposited. So two things happen here. You made an annual contribution, it looks like, and then you process the conversion, which are two different items. So number one, from a contribution perspective, you have until your business tax return due date plus time you filed extension to make prior year contributions. So therefore, it looks like you met the year 2025 contribution deadline. So that's going to count as a contribution for tax year 2025. As far as the conversion, it sounds like you did a mega backdoor Roth conversion where you made a voluntary after-tax solo 401k contribution and then converted those funds to the Roth solo 401k, or in your case, to the Roth IRA. So that's fine as well. That's going to count as a 2026 conversion. And it doesn't matter whether it's treated as a tax year 2025 conversion or a tax year 2026 conversion, because those are voluntary after-tax solo 401k funds, and it also will not impact your ability to also do a year 2026 mega backdoor Roth solo 401k conversion for your tax year 2026 contributions. A point of distinction here is that the contribution deadline rules are different from the conversion deadline rules. The contribution rules allow you to make contributions for the prior year and the following year by your business tax return due date plus timely filed extension, whereas conversions are always reported in the year that the funds are actually deposited or converted from the voluntary after-tax solo 401k holding account to the Roth solo 401k or the Roth IRA. So in your case, it's going to count as a year 2026 conversion. But again, it's not going to have any impact from a tax perspective. We actually get this question quite a bit this time of year and all the way through October. So we'll be covering this in more depth here, I'm sure. Here's a question here. If I already have a solo 401k with Fidelity, can I still open a new 401k with after-tax contribution option? Second question is, I'm still eligible to claim $1,500 credit now for 2025 tax year. Good question. So your first question is, yes, you can convert that existing Fidelity solo 401k plan to a solo 401k plan offered by my solo 401k financial. If you want to use IRS lingo here, that's called a restatement. When you change from one current solo 401k provider, in this case Fidelity, to another solo 401k provider, in this case my solo 401k financial, that's referred to as a restatement. So a restatement means that we would pick up and move that Fidelity solo 401k plan over to a solo 401k by my solo 401k financial. Sticking with Fidelity is we would help you use Fidelity investments to open up new brokerage accounts known as non-prototype investment-only brokerage accounts for the plan offered by my solo 401k financial. So yes, Fidelity does provide brokerage accounts for solo 401k plans offered by my solo 401k financial. They're known as non-prototype investment-only brokerage accounts. We would prepare those for you. Then they would be open at Fidelity. Subsequently, we would prepare internal transfer forms to move those existing funds and that Fidelity Solo 401k, including securities in kind, so that the funds and securities never leave Fidelity. Those will be transferred in kind to the new brokerage accounts at Fidelity for the Solo 401k offered by my Solo 401k financial that allows for the mega backdoor Roth strategy. So that's how that restatement works, and we process those all the time. I mean, we probably process easily a few every day for Fidelity Solo 401k plans and even Charles Schwab Solo 401k plans. Those are the most popular ones. We also process them for a census. A lot of clients from a census that restate their Solo 401k to my Solo 401k financial. T. Rowe Price, ADP, I mean, the list goes on and on. It can be done with any existing solo 401k plan. Since your question pertains to Fidelity, I'm going to see if I can dig up a link here on our website that talks about restating a Fidelity solo 401k plan to a solo 401k from my solo 401k financial. While I do that, to answer your next question about the auto contribution credit, we would add that auto contribution credit to your plan here in 2026. Therefore, it would not apply for tax year 2025. It would apply for tax year 2026. So starting in tax year 2026, and we'll talk more about that auto contribution credit. And that's because the plan is not being restated until 2026. It's too late to claim that auto contribution credit for tax year 2025 because the plan documents had to have been signed. The plan had to be adopted by the end of last year, but that's for the auto contribution credit. That doesn't impact the ability to still make contributions here in 2026 for tax year 2025 if you open a solo 401k plan here in 2026, or if you restate an existing solo 401k plan here in 2026 to our plan. But let me dig up the restatement link from our website that talks about restating a solo 401k from Fidelity to a solo 401k from my solo 401k financial. And I've located it here. There's that link there. Take a look at that link. Let's go over some slides here and then we'll continue going over the some more questions here. So again, we're talking about how do you still have time to open a solo 401k plan here in 2026 to make certain types of contributions for tax year 2025. So let's break it down by self-employed entity type. If your self-employed business is taxed as an S corporation, then you can open a solo 401k plan here in 2026 for the first time, and you're going to qualify to make both employer profit sharing contributions, which are tax deductible if you make them as a pre-tax contribution. And you're also going to qualify to make voluntary after-tax solo 401k contributions for tax year 2025. However, you will not qualify to make employee contributions because the plan had to have been established by December 31st in order to be able to make employee contributions in 2026 for tax year 2025. If you file a tax return extension for that S corporation, so the Form 1120S extension for that S corporation, you're going to have an extra 6 months to open a solo 401k plan here in 2026. So by September 15 of 2026, so that you can make tax year 2025 employer profit sharing contributions as well as voluntary after tax solo 401k contributions by that same date. And now listen carefully here because it's more advantageous from a contribution perspective if your self-employed business is taxed as a sole proprietorship. If your self-employed business is taxed as a sole proprietorship, you're going to be able to make all contribution types for tax year 2025 here in 2026. So if you open a solo 401k plan for the first time here in 2026, and you do so by April 15 of 2026, you're going to be able to make employee contributions. You're also going to be able to make employer contributions and voluntary after-tax solo 401k contributions. If you file a business tax return extension for that sole proprietorship, so effectively a personal Form 1040 extension, you're going to have an extra 6 months to open that solo 401k by October 15 of 2026, and you're going to be able to make both employer profit sharing contributions and voluntary after-tax solo 401k contributions by that same date for tax year 2025. However, you will not be able to make employee solo 401k contributions because in order to do so, you're going to have to open that solo 401k plan by April 15 of 2026 so that you can make tax year 2025 employee contributions. If your self-employed business is taxed as a partnership, it's just like an S corporation in that you have until March 15 of tax year 2026 to open the solo 401k plan and make tax year 2025 employer profit sharing contributions, as well as voluntary after-tax solo 401k contributions, but you will not be able to make employee solo 401k contributions because just like an S corp, the plan had to be adopted by December 31st, 2025. If you file for a partnership tax return extension, you're going to have an additional 6 months to open the solo 401k plan in 2026 and make both employer contributions and voluntary after-tax solo 401k contributions by that September 15 of 2026 deadlines for tax year 2025 contributions. So here's a good summary regarding the different self-employed businesses we just touched on. Okay. Excuse me again, I've been fighting a really bad cold here, so pardon my etiquette here. Let's take a look at some more questions. Now, if this information is helping you feel confident, we would really appreciate it if you take a moment to like and subscribe, because again, it helps tell the platform that this content is valuable and it helps others find this more easily. So, and again, subscribing also guarantees that you receive information as to when we go live. So you'll receive notifications. So here's a question. My wife is an author with an LLC. Sounds great. I'm a full-time W-2 with a 401k that I max out. I put in a lot of work publishing my wife's books. Can I also contribute to the solo 401k, or is it best to have my wife's max? Great question. So yes, as long as you're also doing self-employment activity under that LLC, so that LLC can be taxed as an S corporation, it can be taxed as a partnership, or it can be taxed as a sole proprietorship. Let's say that LLC is taxed as a sole proprietorship. That means that you would both work under that LLC. So you would each file a separate Schedule C under that LLC. Therefore, you would both be able to participate in the solo 401k plan. So just one plan. Your wife doesn't have to contribute to the plan, but she can if she wants to, but you can contribute to the plan even if she doesn't. So we would set up a solo 401k plan with here's an example of a two participant plan. Let's say both of you are working in the same LLC. You would both participate in the same solo 401k plan. So we would help you open up 6 separate participant account, aka holding accounts to hold your funds. A pre-tax bucket, a Roth solo 401k bucket, and an after-tax known as the voluntary after-tax bucket. And you would both be able to contribute based on your respective self-employment income. Or again, if just you want to contribute to the plan, then the plan would be sponsored by the LLC, and we would help you to open up just 3 separate holding accounts to hold your funds. And that's not, and the fact that your wife doesn't contribute to the plan won't impact your ability to contribute to the plan as long as you also have earned income from self-employment activity under that LLC. Because remember, when you make contributions to a solo 401k plan, they have to be based on earned income. It cannot be based on passive or investment income. And also the fact that you contribute to a full-time employer plan to your daytime job, that's not going to impact your ability to make employer profit sharing contributions or voluntary after-tax solo 401k contributions, because neither employer profit sharing contributions nor voluntary after-tax solo 401k contributions are impacted by your daytime job 401k contributions. That's why we have a lot of high net worth clients who tend to be professionals, such as doctors and accountants and CPAs, where they may work for a full-time employer plan or full-time employer business that sponsors a full-time employer 401k, and they maximize all their contributions to that full-time employer 401k, and then they have a side business, or they're working in the same business as their spouse, and they're able to open a solo 401k for that side business, and they're able to maximize their annual contribution to the voluntary after-tax solo 401k, which is $70,000, for example, based on their earned income from that self-employed business, and it's not impacted by the contributions made to their daytime job 401k. So they make a $70,000 annual solo 401k contribution to the voluntary after-tax solo 401k bucket based on tax year 2025 contribution maximums. And then they convert that to the Roth solo 401k, or they'll do an employer profit sharing contribution, and then the difference up to the overall limit as a voluntary after-tax solo 401k contribution, and then they'll convert it to the Roth solo 401k. And we've also have performed many webinars on that topic as well. You can visit, you can join our YouTube channel, and you can view those various webinars. As a matter of fact, let me send you a link from our website that talks about contributing to multiple 401k plans. That is a full-time employer 401k, as well as a solo 401k plan. Give me a moment here while I dig that up here. So, and we have a video on that on this particular page I am about to share that talks about contributing to multiple 401k plans and the rules surrounding that. Okay, here's the link to that page. Okay, good question. Let's before we transition to the mega backdoor Roth, which is a popular feature that many of our clients utilize their solo 401k for, let's see if we have any other questions here. Here's a question. I'm looking into opening a solo 401k as a 1099 contractor. For 2026, can I put the max contribution of $72,000 in a post-tax account through the solo 401k and have the money rolled over as a backdoor Roth? Good question and timely question, and the answer is yes. We're going to talk about that more right now. So let's transition to that. That's known as the mega backdoor Roth. So with the mega backdoor Roth, that's a way to make voluntary after-tax contributions to your solo 401k, which are not deductible when you make them. But once you convert those funds to the Roth Solo 401k plan, they're going to grow tax-free. So you're never going to have to pay taxes on those gains inside that Roth Solo 401k. And I know your question deals with 2026, but it's the same rules regarding how it works for tax year 2025. So here's how it would work. You would make a voluntary after-tax solo 401k contribution to the voluntary after-tax solo 401k bucket, aka participant account, also known as a holding account. For clients that utilize my solo 401k financial, you get to choose where to hold your funds at. That's why we're very popular when you compare us to other self-directed solo 401k providers, and that is it's your money. You get to choose where to hold the money at, whether at Fidelity, Schwab, Altruist, your local bank, credit union, any financial institution that will be willing to hold the solo 401k funds and will help you open up those holding accounts as part of the setup process. So let's say here that you use Fidelity Investments to open the brokerage accounts for the solo 401k offered by my solo 401k financial that allows for the mega backdoor Roth. So this is a one participant plan. We would help you set up the plan. So we would draft the plan documents. We would obtain an employer identification number for the solo 401k plan because the solo 401k plan is a retirement trust. Therefore, it's a separate legal entity requiring its own separate employer identification number. So in addition to preparing the solo 401k plan documents that has all the applicable regulations that allow for the mega backdoor Roth, we would also obtain the employer identification number for that solo 401k. We would then help you open up 3 separate brokerage accounts at Fidelity because you are required to have separate participant accounts, aka holding accounts for each participant and each source of funds. This is an example of a one participant plan, hence why you see 3 separate buckets, aka brokerage accounts, a pre-tax solo 401k bucket, a Roth solo 401k bucket, and a voluntary after-tax solo 401k bucket. Don't confuse this. It's still just one solo 401k plan, but in the industry, we call them Roth solo 401ks, pre-tax solo 401ks, voluntary after-tax solo 401k plans, but it's really considered just one plan that has separate buckets to hold each source of funds. Once you make that voluntary after-tax solo 401k contribution, let's say $72,000, assuming you have enough earned self-employment income from your self-employed business, whether you're a contractor, which means you would file a Schedule C, so you're a sole proprietorship, S corp partnership, then as long as you have enough earned self-employment income, then for tax year 2026, you can contribute $72,000 to that voluntary after-tax solo 401k bucket and convert that to the Roth solo 401k or to a Roth IRA. And we'll talk about the difference between the two. If you convert it to the Roth solo 401k bucket, then once you convert it, then we need to collect information from you so that we can report that non-taxable voluntary after-tax mega backdoor Roth solo 401k conversion to good old Uncle Sam. So you'll need to fill out our online conversion form, and you can locate that form on the Forms tab of our website. We'll then issue a Form 1099-R to report that conversion to the government. It'll be non-taxable. There might be a little bit of gains. That's why you want to convert it right away, because because you have to convert everything inside that bucket. You'll want to leave like $1 in there, so that way Fidelity doesn't close that brokerage account out, because they tend to close out zero-only brokerage accounts. So you want to make sure that you leave like $1 in that voluntary after-tax brokerage account for future conversions. But once you fill out that conversion form on our website, we not Fidelity will issue the Form 1099-R to report that to the government. and we'll issue a copy to you, and then we'll file a copy with the IRS. So that's how the mega backdoor Roth strategy works. Now, you can also do this for tax year 2025 if you open a solo 401k plan here in 2026. You can make a $70,000 voluntary after-tax solo 401k contribution and convert it to the Roth solo 401k. That's, of course, if you had enough earned self-employment income in tax year 2025. This is an example of a two-participant plan. Let's say you and your spouse are married and you both participate in the same solo 401k plan because you're both working for the same business. You could both perform the mega backdoor Roth for a total of $140,000 for tax year 2025. For tax year 2026, that's $72,000 times two. So talk about really supercharging your retirement savings between you and your spouse. As long as you're both working under the same business and report self-employment activity, you can both contribute to the same plan. You would each have separate holding accounts, but it's still one plan because the plan is sponsored by the business. It's not sponsored by you or your spouse, it's by the actual business. So as long as you both work under that same business, you can both participate in the same plan and perform the mega backdoor Roth. So we oftentimes get the question, should I convert my voluntary after-tax solo 401k contribution to the Roth solo 401k or the Roth IRA? So this slide here will hopefully help you understand and make an informed decision, because we let you decide whether you want to convert those voluntary after-tax solo 401k to the Roth solo 401k or the Roth IRA. We find that most clients convert them to the Roth solo 401k plan because the Roth solo 401k plan, just like Roth IRAs, is now subject to require minimum distributions that apply once you reach age 73. You can also borrow from the solo 401k plan through a participant loan. You can't borrow from a Roth IRA. And there are other reasons there. People like to consolidate their retirement funds under the solo 401k plan. So take a look at that slide there. Okay. And we talked about how we would go ahead and prepare the Form 1099-R for that mega backdoor Roth conversion, and how after-tax solo 401k contributions are not tax deductible. The tax year 2025 contribution figures are right here. For 2025, the solo 401k contributions are $70,000. That's the overall contribution limit for the mega backdoor Roth. Let's see if we have some more questions here. Again, we'll be live again here in a few hours. So if we don't get to your questions now, you can join us live then. So can I do 2025 after-tax contribution if we restate in 2026? Yes, you can, because you have until your business tax return due date here in 2026 to make tax year 2025 voluntary after-tax solo 401k contributions as part of the mega backdoor Roth, as well as employer profit sharing solo 401k contributions. Here's a question here. My wife and I recently opened a solo 401k and went to roll over an existing promissory note held in a pre-tax self-directed IRA to the solo 401k. The accounts are at Fidelity and they don't hold promissory notes and those types of accounts. How can we roll the note and close the self-directed IRA? Good question. So you're exactly right. A solo 401k plan that's self-directed means that you, as the trustee of the solo 401k plan, hold on, safekeep the solo 401k alternative investment documents, such as the promissory note and even the recorded deed, if we're talking about a note secured by real estate or if investing in physical real estate. So the self-directed IRA promissory note would be transferred in kind to the solo 401k plan, go ahead and send us an email to business@mysolo401k.net stating that you would like to transfer that self-directed IRA in kind to your solo 401k, and we'll prepare that transfer form and check off the box that it's an in-kind direct rollover from the self-directed IRA of a promissory note to the solo 401k. You're then going to sign that transfer form and submit it to the self-directed IRA custodian. The self-directed IRA custodian will then send you an assignment that says that on this day, such and such self-directed IRA trust company assigned the such and such promissory note from the such and such self-directed IRA to the such and such self-directed solo 401k plan. Once you get that assignment, you then need to work with the borrower in updating that promissory note to list the solo 401k plan as the beneficiary, aka the lender. And then you, as the trustee, will safe keep that promissory note investment in your files. So, no, Fidelity does not hold on to that promissory note. You hold on to it as the trustee of the solo 401k plan. That's one of the major advantages of a solo 401k over a self directed IRA from a cost perspective and a safekeeping side of things, because most self-directed IRA custodians will charge you a fee for the self-directed IRA to simply hold down note in their files. Well, with the solo 401k plan, as a trustee of the plan, the regulations allow you as the business owner to safe keep that note instead of having the custodian hold on to it. So as a result, you save on processing fees and so forth. But no, that note documents will be safe kept by you as the trustee of the plan. So good question. As a matter of fact, let me dig up a link from our website that talks about transferring a promissory note held in a self-directed IRA in kind to a solo 401k. Give me a moment here while I dig that up. Here it is, came right up. On our website, you can search there's a toolbar, there's a little search box on the top right hand corner. If you type in certain information on that search box, it'll bring up information specific to your topic. Here's the link to that particular page. Take a look at that. um, Oh, that's if you're moving from a solo 401k to a self-directed IRA, which might be useful in the future. Let me find one of the other way around when you move from the self-directed IRA to the solo 401k. Give me a moment here while I dig that up. There we go. Actually, that's for a private investment. It's the same concept. Let me see if I can find it here. One moment here. Okay, here's one here. Take a look at this one. But again, it works just like I mentioned there, where the promissory note gets assigned from the self-directed IRA to the solo 401k plan. I know we have one specific to promissory notes reference on our website. I just can't seem to dig it up here. Let me try one last time here. But the link I shared there with you works as well as far as how the process works. Might have to do a separate blog post specifically to that. But again, take a look at that link there. That's going to work for you. Okay. Let's see if we have any more rules, any more questions here, I should say. We're about at the end of our session here. So let's continue with our webinar here. So common mistakes when you're looking to open a solo 401k plan for the first time here in 2026 so that you can make tax year 2025 contributions is you want to make sure that you do so by the business tax return due date plus timely filed extension. Assuming that you can do this at Fidelity or Schwab under their solo 401k plan or any other traditional solo 401k provider, you need to make sure you open a solo 401k plan with the solo 401k provider like my solo 401k financial, whose plan allows for the mega backdoor Roth strategy. You want to make sure that you open up the separate solo 401k participant accounts for each spouse if they both participate in the same plan, as well as separate brokerage holding account source types. That is a pre-tax brokerage account, a Roth solo 401k brokerage account, and a voluntary after-tax solo 401k brokerage account. So here in my solo 401k financial, we would create a custom solo 401k plan that allows for the mega backdoor Roth, as well as solo 401k participant loans, the ability to invest in real estate and other alternative investments like precious metals, cryptocurrency, notes, tax liens, and so forth, as well as equities. We also allow you to hold the funds at the financial institution of your choice, as long as that financial institution's on board, and will help you open up the holding accounts at that particular financial institution. We'll help you calculate contributions, transfer any IRAs, former employer plans to the solo 401k, and we'll take care of the ongoing compliance support upon your timely request. So those are things to keep in mind. Now, let's talk about the let's talk about the auto contribution credit, because we get this question quite a bit. So the auto contribution credit is a $1,500 amount. In order to qualify for the auto contribution credit, you need to be self-employed and be able to open a solo 401k plan. And then you need to make sure you open the solo 401k plan with a provider who offers a solo 401k plan that has the auto contribution credit built into it, along with the applicable schedules. We were actually the first in the industry to offer such a solo 401k plan. More and more providers are now on board as well. So now they're offering it. But we started offering it back on January 1st of 2024. So if you open the solo 401k plan with my solo 401k financial as of January 1st, 2024 and after, then your plan's already drafted with the auto contribution credit built into it. And of course, if you're a new client and open a solo 401k plan here in 2026 or in future years, we would automatically draft that plan with the auto contribution credit. Now, the auto contribution credit is also available to existing solo 401k plans, meaning that if you have an existing solo 401k plan, you can restate that solo 401k plan to a solo 401k from my solo 401k financial, and we can add that auto contribution credit to your plan so you can start claiming that credit here in 2026. Likewise, if you're a client of my solo 401k financial from December 31st of 2023 and prior, we can update your plan to add the auto contribution credit. And you can start claiming that auto contribution credit here in 2026. And you can submit a support ticket through the forms tab of our website so that we can add that auto contribution credit to your plan if you're an existing client. It's a dollar for dollar credit. So the cost of opening and maintaining a solo 401k plan is essentially covered for years to come with this $1,500 auto contribution credit. And what's great about this auto contribution credit is that you are not required to contribute to the solo 401k plan to qualify. You can actually opt out of contributing and still be able to contribute to the plan up to the overall limit, as long as you have earned income. So take advantage while you can. Also, you're going to claim this $500 credit over 3 years. So the $1,500 credit over a 3-year period. So you have to claim it in $500 increments each year for a total of 3 years. For example, if it's added to your plan here in 2026, you can claim the $500 credit with your 2026 tax return, the second $500 amount with your 2027 tax return, and the final $500 amount with your 2028 tax return for a total of $1,500. So you have to spread it out in $500 increments over a 3-year period. And you're going to file Form 8881 each year to claim that $500 auto contribution credit. So a total of 3 times. For my clients of my solo 401k financial, we have a PowerPoint and a video walkthrough. So it's only a 2-page form. It's not very tough to complete, but we do have a video and a PowerPoint that we can provide. Okay, let's see if we have any other questions here before we conclude today's topic. Here's a question here. My wife and I rolled over separate IRA accounts into the 401k at Fidelity. Can the 401k transfers between those individual accounts or must they stay separate? So each of you, if both of you are self-employed in the same business, you would each have separate holding accounts under the solo 401k plan. And then each of you, if you each have separate IRAs, and they're not Roth IRAs because you can never transfer a Roth IRA to the solo 401k, and that's a Roth IRA regulation. You get to this slide here I'm trying to share. So here's an example. I just had it. So here's an example here. Make sure I understand your question. So yeah, you can transfer your respective IRAs to the pre-tax solo 401k. So if you each have a traditional IRA and you're both participating in the same solo 401k plan because you're both self-employed under the same business and the plan is sponsored by the business, that's how it works under the IRS regulations. The plan is set up for the business. Then we can help you to transfer your traditional IRA to the pre-tax solo 401k bucket. So this bucket here, and then your wife's traditional IRA to her pre-tax solo 401k bucket. And that doesn't count towards your annual contribution limits. So annual contribution limits are not impacted by the amount of IRA funds that you transfer to the solo 401k, as well as former employer plans that you transfer to the solo 401k plan. Therefore, you can transfer an unlimited amount of IRAs, whether a traditional IRA, SEP IRA, or simple IRA, to the solo 401k plan, as well as former employer plans like a 401k, 403b, thrift savings plan, 457 governmental plan, defined benefit plan, pensions, and so forth. All right, that's it for today's session. Thank you so much for investing your time with us. Your time is valuable and your retirement future is worth it, in our opinion. Again, if you haven't yet, please like and subscribe to our channel. Like us across various social platforms to help get the word out to other solopreneurs. We'll be back again here in a couple hours. Until then, have a good rest of the day.